Hi everyone, welcome back to my channel. I know I haven't posted in a while, but I am trying to change that. So today we are doing standard costing and we are doing material variances. And of course, this is presented by me, Tabi Mbonambi. What are standard costs and literally why do they even matter? So standard costs are literally exactly that. They are the normal costs that a specific organization would have to incur under normal conditions of operation. So, in an ideal world, if everything goes according to plan, how much would the materials for the business cost? And again, I want to say this is under ideal or efficient circumstances. So that's exactly what they mean by standard costing. In a perfect world, how much would you have to incur per unit for a specific product? One thing I know about my life, and I'm not sure if it's the same for you, but we know that nothing ever goes according to plan. So if you're given a specific cost per unit in terms of what the definition of standard costing is, you will have a variance on that amount purely because we'll never be buying materials for the same price. Inflation happens. Wages may change due to strikes and increases, and sometimes even due to material losses and changes in productivity levels. So let's take a step back and discuss the background of standard costing. Standard costing uses specific predetermined amounts that, as I said, are used under perfect operating activities. But this is different to budgeted costs. Budgeted costs are the entire operation of a business. So let me give you an example. In a perfect world, if budgeted costs are 30,000 Rand for 10,000 units, then the standard cost is 3 Rand per unit. So the standard cost is effectively what informs your budget. Standard costing is perfect for an organization that has activities with common or repetitive operations and where the same type of input is required to produce each unit of output, and there has to be a direct correlation. So let me give you an example. If I'm baking cupcakes, I need flour, I need sugar, I need eggs. I cannot bake, so I don't know what else I need. But what I'm trying to say is the output of the product must be directly attributable to the input of that product, even if they're different products. So there's a factory, it produces microwaves and it also produces fridges. If there are common operations, there will be product variances on these operations because they follow a common or repetitive nature. Remember what I said about standard cost being the cost per unit? So, because they represent those target costs, we now need to talk about the direct material variances of standard costing. And this is what the crux of this video basically is. Because these standard costs represent whatever our target cost is, they are preferable to actual past costs for decision making. This is very different to your FINAC or your auditing because in your FINAC, you will typically be preparing financial statements. In your taxation, you'll be interpreting legislation for an organization or an individual. In auditing, you'll either be the auditor critiquing certain operations or you will be management critiquing your own control environment. But here you are the financial manager who is responsible for the decision making of a specific company. With that, the direct materials that you need to use need to be based on that optimal quantity that we have after considering any unavoidable wastage or loss, because you're trying to make decisions on, should I still be selling these cupcakes? Why am I wasting so much flour? Why are so many eggs being broken? That is the reason we do standard costing in the first place, because these are the required quantity of materials that we use to complete our specified product. And because the standard material costs are simply equal to standard quantities multiplied by standard pricing, the standard pricing provides a base for us to evaluate the actual prices that we pay for materials. Two things that we can see from the above. I just spoke about standard quantities multiplied by standard pricing. There are two elements at play here. One is that the standard price can actually differ from the actual price, and this is called a price variance. And if the actual quantity of materials used differs from the standard quantity, this is called the volume variance. So there are two common variances that we deal with direct materials. Material prices have variances, and those variances are equal to the difference between the standard price and the actual price multiplied by the quantity, the actual quantity. So the difference between your 5 Rand and your 10 Rand price multiplied by your quantity of units that you produce. So why do we use the actual quantity and not the standard quantity? This is purely because we're trying to figure out why there's a difference between the standard and actual price. Because the actual quantity is what we purchased. So if I tell you that my company produced 2,000 units, but I was supposed to spend 5 Rand on the eggs, and I ended up spending 7 Rand on the eggs, I don't care about how many units I should have produced. I care about the actual units that I produced. And that's the actual quantity that we purchased. And that's why we use the actual prices. So if product X has a standard price of 10 Rand per kilogram, 20,000 kilograms are purchased, or planned to be purchased rather, but the actual price per kilogram is now 12 Rand. And 20,000 kilograms are actually purchased. So we're in luck here because the quantity that we planned on purchasing is the quantity we actually purchased. But now there's a difference. We said the standard price was 10 Rand, but now the actual price is 12 Rand. So we have a difference. So what I used to do when I was a student, I would always start off with the standard price less the actual price. And this matters because you get your positive or negative sign when you're actually doing the calculation. Because your 10 Rand less your 12 Rand times 20,000 Rand gives you negative 40,000. And in my head, I knew, okay, this was an adverse difference of 40,000 Rand. So I have a material variance, a material quantity or volume variance of 40,000 Rand. So now let's use product Y as an example to prove my point. Product Y has a standard price of 10 Rand per kilogram. 20,000 kilograms are planned to be purchased and are actually purchased, but now the price is 9 Rand per kilogram. So as I said, start off with the standard cost of 10 Rand minus the actual cost of 9 Rand times the 20,000 units actually purchased. And that gives you a positive 20,000 Rand. So in a test or exam, I would expect you to always indicate if it's an adverse or a favorable variance. I don't care if we're talking material price variance, material volume variance, material yield, material mix, it doesn't matter. Always indicate whether it's favorable or whether it's adverse. So here we obviously have a saving, so we have a material price variance of 20,000 Rand. But what if product Y was inefficient? This this product here, this product Y that we got for 9 Rand, what if it was actually inefficient? And this is where volume variances come in. So sometimes if you buy an inferior product, you might have to end up spending more money or having adverse volume variances or usage variances. So remember, now we're dealing with volume. We're dealing with how many should have been used versus how many were actually used. So now we calculate the difference between the standard quantity required for production versus the actual quantity we used times, and this time we multiply by the standard material price. Why do we multiply by the standard material price? Because we are trying to keep something consistent. So we are trying to see what is the volume variance that should have been met under the most ideal conditions. So that is why we use the standard material price as opposed to the actual material price. Here's another example. If product Y had planned to use 20,000 kilograms of eggs, but used 21,000 kilograms, they bought substandard products, but they had a standard cost of 12 Rand and an actual cost of 10 Rand. So you're going to take the actual produced, the 21,000, and subtract it from the standard volume, which is 20,000 kilograms, multiplied by the standard material price. And as I said, we use the standard material price because we want to see what conditions should have been met under ideal circumstances. So obviously now the total material variance would be equal to the standard cost less the actual cost. Just from a theory perspective, if you get asked something like this, you know material usage variances. There could be careless handling of eggs by the production personnel. You could buy inferior quality products. So the material that you buy in making those products, the eggs were off. They were one day, past the best before date. And there could be quality control requirements or changes in methods of production. So there are a lot of factors that could play a role in making a material usage variance possible. Like with material price variances, inflation is something we could consider. The change in the repo rate is something we could consider. So those are the main elements of a price variance and a material variance, material volume variance rather. Whoa, now it's getting serious. We're getting to mix and yield variances. A material mix variance exists when the materials used differ from a predetermined mix. So by implication, you need to have more than one material going into the product. So if you have product X and product Y, you have your eggs, you have your milk, and you produce your cupcakes. If your eggs and your milk change, that means that the mix that you used it in is no longer the same. So why was there a change in the mix? That's what we're trying to figure out. So how do we calculate the material mix variance? So I'm going to do the example, but let's take it back a step. It's the actual quantity in the standard mix proportions less the actual quantity used multiplied by the standard price. I had these slides on the example, but I'm going to dive into an actual example that you might get in a test or exam. You have direct material A. Direct material A uses 10 kgs for each X338 product. So if material A is 10 kgs for that product and we use direct material B 5 kgs and that's 25 Rand for this product, that means that we would expect that this mix of products remains the same. So it's a 2-to-1 ratio. For every one material B, you use two material A's because it's 5 kgs and it's 10 kgs. But now we're told that we budgeted for 2,000 units. As I said, the budget is the overall thing, but we care about the actual now. The actual is now going to be the 2,150 units because those were our production costs. Please do not take the sales into account. The sales are what you're going to calculate your sales variances with. We are dealing with the inputs of the product, our internal problems. So let's see what goes on. Direct material A, in actuality, used 2950 kilos, and direct material B used 11,390 kilos. So obviously you can see there's a problem here. It's no longer 2:1 because 2950 divided by 2 is not equal to 11,390. And because of that, we already know that there is a material mix variance. We know it, but how do we calculate it? And that's the question. So what I said was, and this is why I skipped everything and I went straight into this example, because I genuinely believe that what we need to do is we need to use the knowledge that we have to facilitate the knowledge that we're gaining. So remember, in answering the weighted average cost of capital, what you did was you took the A, the 21,500, the B, the 10,750, and you got a total. So think about this as cost of capital, equity, and cost of capital debt. Please forgive my material B spelling. I am not a writer. I am purely doing this for standard costing purposes. So 32,250 is our total in the standard production. So how do I know this? Because our budgeted sales were 2,000 units, but our actual sales were 2,150 units. So budgeted sales was 2,000 units, and the standard pricing thereof is going to be obtained by purely saying, okay, fine, how much would 2,000 units cost me? So 2,000 units would cost me 21,500 using 2,000 units times the 80 Rand. And material B used 25 Rand. So 25 times the 2,000 units divided by 5, I think, would get you to an answer of 32,250. So you need to calculate what material A and material B is in those proportions. So what I basically mean by this is that if you take your units, the 2,000 units you produced, right? And each one, so 10 kgs is 80 Rand. So how much is 1 kg worth? 1 kg is worth the 80 Rand divided by the 10 kgs, and it's equal to 8 Rand. Material B is equal to 5 Rand, which we get by saying 25 Rand divided by 5 kilos. So now if you take that 8 Rand for material A and multiply it by the 2,150 units, you get 21,500. I literally did not read my scenario. So let's go back. The budgeted amount of units and the standard cost thereof is 10 kgs for 2,000 units. The actual was 29.50 and 11,390. So the actual is 29.50 and 11,390 for 2,150 units produced. But for 2,000 units produced, what we'd have to do is multiply the 2,150 units by the actual standard kgs. The reason we're multiplying it by the actual standard kgs is because remember we're trying to find out how much should we have produced using a specific amount of kilograms. So we should have, if we got 2,150 units, we should have produced 21,500 in terms of our standard costing for material A. If we use the 2,150 units, we should have gotten 10,750 for material B to get to the 2-to-1 ratio. So now that's equal to our 32,250, and we use our baaaack principles, as I was saying before. So you say 21,500 divided by 32,250 multiplied by the actual total, because the actual total here is what actually happened. And therefore, you get your standard usage in your actual quantity or your flexed quantity of 21,560. Let me repeat that. 2,150 units multiplied by the 10 kgs gives you 21,500. That means that material B also has the same thing of the 5 multiplied by the 2,150 to get to the 10,750. So that's your standard price for the 2,150 units produced in a 2-to-1 ratio. However, our actual, which is given to us, is 29.50 and 11,390. So we now have to calculate of this proportion, how much of it was actually the quantity that we produced. So 21,500 in its proportion to 32,250 multiplied by the actual number of units gives you what our standard usage should have been in our actual quantity. And as you can see, 10,780 multiplied by 2 is equal to 21,560. So now we return to the 2-to-1 ratio, but for the actual quantity that has been produced. So as I said before, 21,500 divided by the 32,250 multiplied by the 32,340 gives you your 21,560. Exactly the same to get to the 10,780. So here's our summary. Material A, 29.50 for 8 Rand per kilogram. Material B, 11,390 and 5 Rand per kilogram. Step 1, the actual usage in your standard proportions. And step 2, just calculate the variance. So what was our standard? Our standard was 29.50, or our standard was 21,500 and your 10,750. We use the standard to actually calculate the standard usage in the actual quantity, and we use it to produce the calculations for what that particular mix should have been in the 2-to-1 ratio. So now that we have our 2-to-1 ratio, and we actually weighted this 2-to-1 ratio here when we got the 21,560 and the 10,780 and our price, I just put the price here for us to be able to say 21,560 less the 2,950 multiplied by 8 gives you a variance of 4,480. What this effectively leads to is a mixed variance. So our standard is supposed to be 2950, but our weighted is 21,560. That means we actually, for material A, used less than what we expected to use. So because our standard, our actual quantity that we would have produced in the standard usage is 21,560. We expected, we actually, in your actual usage, in your actual quantity, and now I'm mixing up my words, our actual units and our actual quantity are 2950. Our actual units in our actual quantity is 11,930 for material A and B respectively. But we used 21,560 when we did our standard costing. So can you see that the actual and the weighted are, have a difference? Can you see that? Am I the only one that sees the difference? So because we planned on using 21,560, if we produced more units, which is the 2,150 units versus the budgeted 2,000 units, we have a positive mix variance of 4,880. What I'm missing from my answer is to put in brackets F for favorable. For material B, we planned on using 10,780 for the materials produced of 2,150. But we used more. We used 11,390. So again, your 10,780, which is your standard proportion, the actual usage in your standard proportion, less your 11,390, which is your actual usage in your actual proportions, times 5, because we used more than we'd anticipated, we have an adverse mix variance of 3,050 Rand. And that's literally how you do mix variances. I'm going to now talk about yield variances, and that's going to be the last part. So as I said, I did this example. I decided to use a formula, but I'm not a person who thinks in linear terms. I'm a person who uses diagrams to explain what I mean, even to myself. So I want to use this example again. I love this example. So this example becomes really simple when you figure out how to flex or how to use your standard proportions versus in your actual usage. So your 20,950 actual quantity in actual usage, actual quantity in actual usage for direct material A and B. And now, how do we do this? Here's our actual. Here's our weighted. But if we were to look at the yield of this, we would say, okay, material A is 10 Rand per unit. And how did I find that out? I said 80. So material A has 10 kgs, sorry. Material A uses 10 kgs. And what was I supposed to yield with that 10 kgs? I was supposed to yield 21,500. But what I actually yielded was 21,560 when I weighted it. My difference is 60 Rand because my actual kilograms that I yielded from using this particular product is 21,560 when I used my standard costing. So I had planned to use 21,560. I actually used 21,500, which is really great for me. And I am left with the following formula. And now this is where I go back and look at my formula with further understanding. So ignoring all these other slides, I say, what's my actual yield? The actual yield here was 21,500 and yeah, 21,500. That was my actual yield. And we subtract that actual yield from the standard yield from the actual output of material, i.e. our flexed amount, multiplied by the standard cost per unit of output. What I mean by that is this is basically your actual. This is our weighted kilograms, which we've already calculated. This is how much we would have produced from a standard perspective, but this is how much we yielded in terms of the material we used to produce those units. So we expected to use 21,560 to yield the same amount of units because we're keeping the units consistent. We are keeping the units at 2,150. Because the 2,150 gives us the 21,560, when we weight it as we did before over here, we are now sitting at the standard usage in the actual quantity of 21,560 and 10,780. I don't want to make this video too long. So our difference between the weighted kilograms and the actual kilograms is 60 multiplied by the price, and you get a favorable price variance, favorable yield variance. Then you do exactly the same thing for material B. You get your actual kilograms less your standard kilograms, basically. And we see here that we should have used 10,000. We should have yielded from this. We should have yielded in producing 2,150 units. We should have yielded 10,780. But how much did we actually yield? We actually yielded 10,750 units. So this is what was tripping me up. I had a negative sign here and I was confused as to why I should have yielded 10,780 kilograms, but the actual yield was 10,750, and why I was getting a negative or unfavorable yield variance. Because what would have effectively happened is we expected to use 10,780. We actually used 10,750 multiplied by 30. That gives us a difference of 30 multiplied by 5. That gives us a positive yield variance of 150. So a yield variance basically stipulates that if I were producing 2,150 units, how much did I expect to use and how much did I actually use? So you have two favorable price variances of 480 and 150. And that is where I stop this video. So after that roller coaster of that positive 150, that positive 480, I finally got to the correct yield variance. And to you all that have listened to this far, I say thank you, and I will try and be more active on this channel. Cheers!